INTRODUCTON. The term health insurance is commonly used in the United States to describe any program that helps pay for medical expenses, whether through privately purchased insurance, social insurance, or a non-insurance social welfare program funded by the government. Synonyms for this usage include health coverage, healthcare coverage, and health benefits, and medical insurance. In a more technical sense, the term is used to describe any form of insurance that provides protection against injury or illness. In America, the health insurance industry has changed rapidly during the last few decades. In the 1970s, most people who had health insurance had indemnity insurance. Indemnity insurance is often called fee-for-service. It is the traditional health insurance in which the medical provider, usually a doctor or hospital, is paid the fee for each service provided to the patient covered under the policy. An important category associated with the indemnity plans is that of consumer-driven healthcare (CDHC). Consumer-directed health plans allow individuals and families to have greater control over their healthcare, including when and how they access care, what types of care they receive, and how much they spend on healthcare services. These plans are, however, associated with higher deductibles that the insured have to pay from their pocket before they can claim insurance money. Consumer-driven healthcare plans include Health Reimbursement Plans, HRAs, flexible spending accounts, FSAs, High Deductible Health Plans, HDHps, Archer Medical Savings Accounts, MSAs, and Health Savings Accounts, HSAs. Of these, the health savings accounts are the most recent, and they have witnessed rapid growth during the last decade. What is a health savings account? Health Savings Account (HSA) is a tax-advantaged medical savings account available to taxpayers in the United States. The funds contributed to the account are not subject to federal income tax at the time of deposit. These may be used to pay for qualified medical expenses at any time without federal tax liability. Another feature is that the funds contributed to health savings account roll over and accumulate year over year if not spent. These can be withdrawn by the employees at the time of retirement without any tax liabilities. Withdrawals for qualified expenses and interest earned are also not subject to federal income taxes. According to the U.S. Treasury Office, health savings account is an alternative to traditional health insurance. It is a savings product that offers a different way for consumers to pay for their health care. HSAs enable you to pay for current health expenses and save for future qualified medical and retiree health expenses on a tax-free basis. Thus, the health savings account is an effort to increase the efficiency of the American healthcare system and to encourage people to be more responsible and prudent towards their healthcare needs. It falls in the category of consumer-driven healthcare plans. Origin of Health Savings Account. The Health Savings Account was established under the Medicare Prescription Drug Improvement and Modernization Act passed by the U.S. Congress in June 2003, by the Senate in July 2003, and signed by President Bush on December 8, 2003. Eligibility. The following individuals are eligible to open health savings account: those who are covered by a High Deductible Health Plan (HDHP), those not covered by other health insurance plans, those not enrolled in Medicare for. Also, there are no income limits on who may contribute to an HAS, and there is no requirement of having earned income to contribute to an HAS. However, HAS can't be set up by those who are dependent on someone else's tax return. Also, HSAs cannot be set up independently by children. What is a High Deductible Health Plan (HDHP)? Enrollment in a High Deductible Health Plan (HDHP) is a necessary qualification for anyone wishing to open health savings account. In fact, the HDHPs got a boost by the Medicare Modernization Act, which introduced the HSAs. A high deductible health plan is a health insurance plan which has a certain deductible threshold. This limit must be crossed before the insured person can claim insurance money. It does not cover first-dollar medical expenses, so an individual has to himself pay the initial expenses that are called out-of-pocket costs. In a number of HDHPs, costs of immunization and preventive health care are excluded from the deductible, which means that the individual is reimbursed for them. HDHPs can be taken both by individuals self-employed as well as employed and employers. In 2008, HDHPs are being offered by insurance companies in America with deductibles ranging from a minimum of $1,100 for self and $2,200 for self and family coverage. The maximum amount out-of-pocket limits for HDHPs is $5,600 for self and $11,200 for self and family enrollment. These deductible limits are called IRS limits as they are set by the Internal Revenue Service (IRS). In HDHPs, the relation between the deductibles and the premium paid by the insured is inversely proportional, i.e. higher the deductible, lower the premium, and vice versa. The major purported advantages of HDHPs are that they will lower healthcare costs by causing patients to be more cost-conscious, and make insurance premiums more affordable for the uninsured. The logic is that when the patients are fully covered by health plans with low deductibles, they tend to be less health conscious and also less cost conscious when going for treatment. Opening health savings account, an individual can sign up for HSAs with banks, credit unions, insurance companies and other approved companies. However, not all insurance companies offer HSA-qualified health insurance plans, so it is important to use an insurance company that offers this type of qualified insurance plan. The employer may also set up a plan for the employees. However, the account is always owned by the individual. Direct online enrollment in HSA-qualified health insurance is available in all states except Hawaii, Massachusetts, Minnesota, New Jersey, New York, Rhode Island, Vermont and Washington. Contributions to the health savings account. Contributions to HSAs can be made by an individual who owns the account, by an employer or by any other person. When made by the employer, the contribution is not included in the income of the employee. When made by an employee, it is treated as exempted from federal tax. For 2008, the maximum amount that can be contributed and deducted to an HSA from all sources is $2,900 self-only coverage, $5,800 family coverage. These limits are set by the U.S. Congress through statutes and they are indexed annually for inflation. For individuals above 55 years of age, there is a special catch-up provision that allows them to deposit additional $800 for 2008 and $900 for 2009. The actual maximum amount an individual can contribute also depends on the number of months he is covered by an HDHP prorated basis as of the first day of a month. For e.g., if you have family HDHP coverage from January 1, 2008 until June 30, 2008, then cease having HDHP coverage. You are allowed an HSA contribution of 6/12 of $5,800, or $2,900 for 2008. If you have family HDHP coverage from January 1, 2008 until June 30, 2008, and have self-only HDHP coverage from July 1, 2008 to December 31, 2008, you are allowed an HSA contribution of 6/12 x $5,800 plus 6/12 of $2,900, or $4,350 for 2008. If an individual opens an HDHP on the first day of a month, then he can contribute to HSA on the first day itself. However, if he/she opens an account on any other day than the first, then he can contribute to the HSA from the next month onwards. Contributions can be made as late as April 15th of the following year. Contributions to the HSA in excess of the contribution limits must be withdrawn by the individual or be subject to an excise tax. The individual must pay income tax on the excess withdrawn amount. Contributions by the employer. The employer can make contributions to the employee's HSA account under a salary reduction plan known as Section 125 plan. It is also called a cafeteria plan. The contributions made under the cafeteria plan are made on a pre-tax basis, i.e. they are excluded from the employee's income. The employer must make the contribution on a comparable basis. Comparable contributions are contributions to all HSAs of an employer which are the same amount or to the same percentage of the annual deductible. However, part-time employees who work for less than 30 hours a week can be treated separately. The employer can also categorize employees into those who opt for self-coverage only and those who opt for a family coverage. The employer can automatically make contributions to the HSAs on the behalf of the employee unless the employee specifically chooses not to have such contributions by the employer. Withdrawals from the HSAs. The HSA is owned by the employee and he/she can make qualified expenses from it whenever required. He/she also decides how much to contribute to it, how much to withdraw for qualified expenses, which company will hold the account, and what type of investments will be made to grow the account. Another feature is that the funds remain in the account and roll over from year to year. There are no use it or lose it rules. The HSA participants do not have to obtain advance approval from their HSA trustee or their medical insurer to withdraw funds, and the funds are not subject to income taxation if made for qualified medical expenses. Qualified medical expenses include costs for services and items covered by the health plan but subject to cost sharing such as a deductible and co-insurance, or co-payments, as well as many other expenses not covered under medical plans, such as dental, vision and chiropractic care, durable medical equipment such as eyeglasses and hearing aids, and transportation expenses related to medical care. Non-prescription, over-the-counter medications are also eligible. However, qualified medical expense must be incurred on or after the HSA was established. Tax-free distributions can be taken from the HSA for the qualified medical expenses of the person covered by the HDHP, the spouse even if not covered of the individual, and any dependent even if not covered of the individual. 12. The HSA account can also be used to pay previous year's qualified expenses subject to the condition that those expenses were incurred after the HSA was set up. The individual must preserve the receipts for expenses met from the HSA as they may be needed to prove that the withdrawals from the HSA were made for qualified medical expenses and not otherwise used. Also, the individual may have to produce the receipts before the insurance company to prove that the deductible limit was met. If a withdrawal is made for unqualified medical expenses, then the amount withdrawn is considered taxable. It is added to the individual's income and is also subject to an additional 10% penalty. Normally, the money also cannot be used for paying medical insurance premiums. However, in certain circumstances, exceptions are allowed. These are 1. To pay for any health plan coverage while receiving federal or state unemployment benefits. 2. COBRA continuation coverage after leaving employment with a company that offers health insurance coverage. 3. Qualified long-term care insurance for Medicare premiums and out-of-pocket expenses, including deductibles, co-pays, and co-insurance. 4. Part A Hospital and Inpatient Services, Part B Physician and Outpatient Services, Part C Medicare HMO and PPO plans, and Part E Prescription Drugs. However, if an individual dies, becomes disabled or reaches the age of 65, then withdrawals from the health savings account are considered exempted from income tax and additional 10% penalty irrespective of the purpose for which those withdrawals are made. There are different methods through which funds can be withdrawn from the HSAs. Some HSAs provide account holders with debit cards, some with checks, and some have options for a reimbursement process similar to medical insurance. Growth of HSAs. Ever since the health savings accounts came into being in January 2004, there has been a phenomenal growth in their numbers. From around 1 million enrollees in March 2005, the number has grown to 6.1 million enrollees in January 2008.14. This represents an increase of 1.6 million since January 2007. 2.9 million since January 2006 and 5.1 million since March 2005. This growth has been visible across all segments. However, the growth in large groups and small groups has been much higher than in the individual categories. According to the projections made by the U.S. Treasury Department, the number of HSA policyholders will increase to 14 million by 2010. These 14 million policies will provide cover to 25 to 30 million U.S. citizens. In the individual market, 1.5 million people were covered by HSA/HDHPs purchased as on January 2008. Based on the number of covered lives, 27% of newly purchased individual policies defined as those purchased during the most recent full month or quarter were enrolled in HSA/HDHP coverage. In the small group market, enrollment stood at 1.8 million as of January 2008. In this group, 31% of all new enrollments were in the HSA/HDHP category. The large group category had the largest enrollment with 2.8 million enrollees as of January 2008. In this category, 6% of all new enrollments were in the HSA/HDHP category. Benefits of HSAs. The proponents of HSAs envisage a number of benefits from them. First and foremost, it is believed that as they have a high deductible threshold, the insured will be more health conscious. Also, they will be more cost conscious. The high deductibles will encourage people to be more careful about their health and healthcare expenses and will make them shop for bargains and be more vigilant against excesses in the healthcare industry.